Hello, everyone. I'm Aubrey Ruby, and I'm a senior fellow at the Africa Center at the Atlantic Council. And it's my pleasure today to be moderating and hosting this discussion on investing in fintech and fintech opportunities in African markets. And it's a timely discussion because while we know that global FDI is down 49% in the first half of 2020, and FDI into Africa is down 28%, according to UNCTAD, one of the bright spots has been investment into Africa's tech ecosystems, whether they be Lagos, Nairobi, Cairo. And within that, the majority is going to the fintech sector. And despite COVID, this doesn't seem to be slowing. And in fact, digitization is accelerating during this time. Also, flagship exits such as the Paystack exit to Stripe fuel this growth. And I'm really joined today by a panel of experts and investors to talk about what they're doing in the space and how they think about it. So first, I want to turn to Ruby Nimkar, who's joining us, and she's going to talk from the perspective of Greenhouse Capital Africa. Welcome, Ruby.
Hi guys, thank you so much. Did you want us to give you a quick background?
Yeah, give us a background of what you're up to and how you play into this fintech space.
Perfect. Yeah, so we are an early stage fintech investor. We predominantly do pre-seed and seed stage investing, come from a largely operational background. So very, very much on the venture building side. We're kind of operators before we're investors, and started out in Lagos, but now running sort of a Pan-African fund with early investments in companies like Flutterwave and Migo and Helium Health. So really exciting players in the space, and overall excited to kind of see how the space grows.
And because of your deep experience in Nigeria in particular, what are the major trends that you're seeing shaping fintech, and how is the Stripe acquisition really shaking it up? I know Shola's been on the speaking tour for some time now.
Yeah, I think there's some pretty key trends on kind of the retail banking and the SME banking space. I think we often see sort of the B2C plays, a lot of e-wallet companies, a lot of agent network type companies as well. And obviously with kind of the inflow of a lot of Chinese players like PalmPay and OPay, there's obviously competition is sort of heating up in that. But I think what's really exciting is specifically targeting SME infrastructure, and how do we actually think about digitizing SMEs? How do we bring them from offline to online, and what kinds of financial tools can we actually provide that segment? So that's something that we're really excited about specifically. And then obviously all of the kind of foundational infrastructure that needs to be built in order to enable these types of businesses to be built on top of. So, you know, companies that are doing things like open banking, and you see kind of the competitors in the plaid space, for example, you know, other companies that are, you know, doing non-predatory lending. So, you know, payday type loans are obviously going away, and there's opportunities for kind of the more alternative credit scoring, and really looking at more targeted lending around that as well. So those things are pretty exciting. And then I think there's some really exciting stuff that's happened around the crypto space as well. So
especially in COVID, I mean, there's a lot of Nigeria's use of crypto to go up, and different during this in SARS protests that happened recently on the streets. You saw a lot of movement towards crypto in terms of crowd financing some of the organizers.
Yeah, absolutely spot on. I think there's been, you know, we haven't found a use case in this space that's so solid. And I think this year really proved that there was actually true use cases and opportunities, both with COVID and with kind of the NSARS crowdfunding.
Yeah, I want to bring in Saad here. Saad Sheikh's joining us from London at the TLG Capital. I mean, how are you seeing the fintech landscape? I mean, you've invested in a variety of companies with a variety of instruments. You know, what do some of these early fintech entrepreneurs need?
No, absolutely, Aubrey, and thanks a lot. Lovely to be on the panel. Very interesting to see how Africa is shaping up. COVID's really, as you rightly pointed out, capital is still flowing in. Believe it or not, I think the capital injection on the fintech side has actually grown in the year of COVID than reduced, specifically looking at the fintech space. With the likes of Paystack and Stripe. And I think a good point that you made is these relationships are not as a consequence of an introduction. They are very incestuous relationships that then turn into a full blown out marriage. Right? And that's what we're seeing. We also tend to invest cautiously at first and then double down within sectors that we really enjoy and like. One of the sectors in the fintech space that I think is going to really catch fire is asset-based financing, but on the digital side of things. I'm working with Uber at the moment to do asset financing for their vehicles. And that's really kicking off for the whole of the continent. But it's entirely tech-enabled. It's completely cashless. There's no cash component, because one of the biggest problems, if I just carry on with this example, is Uber drivers or other such drivers have struggled to take on rides that are not cash, because they need that cash to either buy fuel or insurance or maintenance or pay for their rental outgoings. But if you make it all digital and make the ecosystem digital, i.e., no insurance has to be paid out in cash, fuel is on a card-based system, maintenance is on a card-based system, you're getting your income from Uber, etc., into your account at, I don't know, GT Bank or wherever, because you're supposed to open an account. It creates an entire fintech ecosystem touching the base of the pyramid and going to the top. And that's one of the things that I really have not seen, where the bottom of the pyramid is really getting engaged in the fintech space. It's still 60% of unbanked. And I think that this type of products and solutions is what the African market really needs, where service is highly entrenched to the digital landscape.
Yeah, I'm glad you brought up the inclusion thing. We'll certainly spend some time on that. But I want to come to Mylis Carraro from Catalyst Fund to see the perspective from the investor before we go to Ham and hear it from the entrepreneur, which is always that challenge. But how is Catalyst looking at fintech space right now?
Sure, thanks, Aubrey, and likewise, a pleasure to be with you all today. So at Catalyst Fund, we are actually an early stage global accelerator specifically for inclusive fintech startups. So to Saad's point, we actually primarily and only look at companies that have a mandate to really expand access to financial services, but also improve more holistically the financial health of underserved populations. So unbanked, but more broadly underserved. And so the way we look at fintech is trying to identify the opportunities to really create solutions that we say are accessible, affordable, and appropriate for those underserved populations, and business model that are able to sort of push the boundary, right? So from a product innovation point of view, a business model point of view, in reaching those that currently are not benefiting from financial services and the global financial system. And so we have invested over the years in 37 companies, including Ham. So if we can tell you more, obviously, about our role in his trajectory. And what we've seen since COVID hit is actually that companies in our portfolio and writ large, even when targeting harder to reach population where unit economics are more difficult, have been able to raise funding, have raised actually. So we just announced yesterday a raise for one of our insurtech companies in Kenya that really targets gig workers that are employed from other, for example, apps, but we're really talking about bottom of the pyramid customers here. So that has been a pleasant surprise, because we were certainly worried, like what's going to happen, particularly to these business models that are blending commercial and social impact in this time when this is needed more than ever, right?
Yeah, so Ham, Miley's really teed you up here. And being the sole entrepreneur on this panel, we're going to turn to you, Ham Saranjoji from Chipper Cash, and give us a sense of what it's like to be a fintech startup in this space. The good part is you have a lot of investors who are interested. Is there a match to the opportunity, do you think? Is there enough money out there?
Yeah, thanks, Aubrey, and thanks for having me here today. Miles has been very humble in describing what they do, but Cutlass Fund has been an incredible part of the very early stages of Chipper and our development. I think today the story around investing in Africa is an exciting story, particularly in fintech, but it's one of those stories that gets significantly better as the market expands. And you know how they kind of say that the first person to run to the wall typically gets the most damage. And when we, started Chipper 2 years ago.
Tell us what Chipper does, though. You got to keep our audiences in suspense if they haven't heard of you yet.
Absolutely, yeah. So we're a cross-border mobile payments platform, predominantly focusing on cross-border intra-Africa payments. So it's very analogous to how people in the West might use Cash App or Venmo to send money across friends in the US. But we do that across people in Africa in different countries. So we're now available in 7 countries in Africa: Uganda, Kenya, Nigeria, Ghana, South Africa, and Tanzania. And we're expanding quite fast. We have over 3 million users today. And we've raised over $20 million in venture capital in the last 2 years. So the
banks, or how do you manage the currency exchange and the kind of currency risk in this case?
Yeah, it's a very complicated operational dance that our team does on the back end, but it's a combination of working with banks and other partners on a liquidity perspective to make sure that we're not exposed to the currency fluctuations significantly. And that's a combination of having different currency float pools in different countries. So we're managing our needs on a sort of case-by-case basis, depending on which country is a bigger recipient than a sender and which country is a bigger sender than a recipient. And so we have capital in those countries accordingly. But those are some of the challenges when you start dealing with intra-Africa payments that come up. It's that, you have a continent like Africa that has 54 countries, 54 different currencies that are all very volatile. And how do you build a business that can support low-cost money transfers for low value amounts at scale? And so those are the very interesting challenges that come up. And those are the things that we had to speak about in depth in the very early days when we were trying to raise money, because investors coming to the space, that's all the risk that they see. And we try to focus on the opportunity that exists today. And I fundamentally believe that fintech in Africa is probably the biggest opportunity today, just period, in terms of growth and impact in the world. And so it's a massive space to be a part of, but there's also still significant challenges that we have to solve as we keep scaling.
For sure, and many have tried it in the past, and I know not only individuals need those kind of services on transferring money, but companies as well.
Absolutely.
And so I don't know, are you seeing a corporate use case or an SME business use case in addition to individuals?
Yeah, we do have businesses that rely on us as well. It's quite exciting to see the level of need for a product that lets people send money across borders in a cost-effective manner. I mean, prior to Chipper, people were spending upwards of 10% on average per transaction to send money from Nigeria to Ghana or from Uganda to Kenya. And that's highly expensive. And that's for the people that can send money. If you think about the ones who are in the lower value transaction bucket, that's just, that prices them out of the space. So there was also an accessibility angle that was important to address from that perspective. But there's a huge business use case. Businesses like people have the same challenges moving money from one place to another.
Yeah, I want to come back to this question of inclusion because, I think that many people get lulled into complicity when they think about the mobile money case, because we look at Kenya and we look at the M-Pesa experience and outsize it, because that's not been the experience in many other African countries. In Nigeria, The digital economy report by the World Bank says that the average Nigerian makes 0.4 mobile money payments a year. So not even a full one, because mobile money just penetration is very different in some countries. So, how is it that, and that all of this money that's gone into fintech is kind of servicing the same user pool? And so that question of like, is it an app that makes the richer people just a little bit more convenient, or does it actually expand the pie and really bring inclusion out? So, Miley, I want to start with you, but I also want to encourage our audience. We're seeing questions start to come in. I will weave them in as we go. So please continue to post if you have questions. We're watching them. I see you. So we're going to bring them in. But Miley, what are your thoughts? How does Catalyst look at inclusion when it looks at investing in fintech?
Great question. So I think what you said is really right, that we can't just look at the situation in Kenya and the growth that mobile money has had there and say, okay, this is the same situation applies everywhere in Africa. It's actually very different, and it's certainly an outlier in terms of the penetration of smartphones, the penetration of internet access, as well as just the sheer volume that goes through mobile money accounts on a daily basis. When you look, for example, the data from the GSMA. So we, however, look at it as an opportunity, as Ham was saying. So we're currently operating in 5 core markets. And in Africa, we're operating in Kenya, in Nigeria, and in South Africa. So you'll say, okay, it's the markets where everyone is going and everybody, the usual suspects, so to speak. And yet, as you said, there's still a huge gap to really go to the last mile, really go to those customers that are not yet onboarded to those digital solutions.
Is it, one argument, I've been doing a lot of events around Africa this week, right? So that's the telco world. And, one argument is that it's the cost of data. One argument is that it's the cost of a smartphone. And, at least on smartphone costs, we've seen those drop dramatically over the years. And, over the last 20 years, we know that Africa has over 600 million mobile connections. So, is it the device, or what's your view on the kind of biggest trigger points of financial inclusion?
Yeah, I think it's a number of things. It's not one. You can't single out one reason that is at the.
So give me top 3. What do you think
the top 3 are? For me, the top 3 actually are still cost of data, not the device. So there needs to be efforts to reduce that cost. Second is actually a better infrastructure in terms of offline and online touch points. So how do you actually reach those people in rural areas? And it's a really important point. And thinking about new technologies that are actually able to go to reach them, for example, USSD, right? Like think beyond smartphones.
And that aspect of getting those out there, right? Agent banking, the agents are key. If you talk to, Tayo Ovioso and Paga, he would say that when he started out, he didn't understand that the agent network was his real asset there, the distribution platform.
Exactly. And it's always been, and now I think we're seeing also with other companies, like digital commerce companies that are adding payments or adding other financial services, but need the distribution. So distribution is the second key barrier. And then I think a third is still regulation, and regulation also around key infrastructure pieces like digital identity, and other banking infrastructure like open banking APIs that could actually enable the move to FinTech 3.0, so to speak. Like we're beyond the just opening mobile wallets, like what's next to really serve those segments.
Well, building off of that, we have 2 questions from the audience that kind of feed directly into those. One about regulators, and Ham, we'll turn to you on that. What has it been like to navigate the regulatory bodies to be able to do what you've been doing across so many countries? And then the other about credit scores and credit worthiness, because at the backbone of, let's say, Saad, we'll turn to you on this, on the models that are doing asset financing, you have to assess credit somehow. So Ham, first, what has it been like in terms of navigating all these regulatory environments?
Yeah, it's a complex effort, both in terms of how fragmented it is in different countries, but then also in terms of in many geographies that we work in, there's actually not that sophisticated of a regulatory regimen to handle fintechs. You always have this dance where innovation is ahead of the regulation, and you have to work very closely with the regulators to make sure that they understand where the markets are heading, the problem you're solving, and how they fit into that whole equation. The good news is that every African country we work in, all governments are quite keen on financial inclusion, and essentially replicating what happened in Kenya with M-Pesa in their own countries. And M-Pesa's growth was in large part due to how the government protected that product and that industry, and they let it really grow and blossom.
Or the Safaricom monopoly.
That's a fair point too.
Well, I mean, scale is everything, right? And a monopoly gave them scale. It's, when they launched, between 7 and 8 out of 10 Kenyans had a Safaricom account, which is not the case in a highly competitive market like Nigeria.
And I think as the product became stronger, the monopoly became bigger as well. But I think initially, the banks in Kenya really came strongly against M-Pesa, and the government had to fend them off for the product to grow. So before it was a monopoly, it had to be protected by the government. And that's a huge part of what regulators can do to foster innovation in the economies. And so we work very closely with different regulators in different countries to make sure that our product fits their vision for what financial inclusion looks like, and that we're actually both on the same side in terms of we want to have financial inclusion, we want it in a safe manner. I keep telling everyone that the people who don't want bad activity on their platforms the most are the people who own the platforms. Because the minute you have fraud and insecurity in the platform, no one will use it. That's like the worst business decision to.
Yeah, but in order to use your platform, you have to have a bank account?
Not exactly. So we try to have it as low requirement as possible. So in different geographies, we work with different products. In Eastern Africa, mobile money accounts work. In Western Africa, it's bank accounts because, like you mentioned,
yes. In Nigeria, bank transfer.
Yeah,
even the police take bank transfer if you get stopped.
It works much more extensively in Nigeria than it does in East Africa. So our product is tailored to what works best in that specific geography, and we make sure that it fits with what people expect. I think the point that Saad made about relevance of products in geographies is really important. If you want to have a product that works well, it has to really meet people's needs as opposed to the opposite.
Yeah, and Saad, I want to come to this question of credit scores, because it's really at the back end of asset financing, which you and I both think is a very interesting space, and exactly coming out of the Africa discussions where I was with CIOs and CEOs of major telcos. They'll tell you one of the things they're expanding into is asset financing for phones. So they're getting very involved. They, of course, have lots of data that can be used for credit scores. But, what else are you seeing in this space on how companies can determine credit in interesting ways for asset lending?
It's a very good question, a very important one, right? Because I think asset lending or any form of lending is backed by data. And given how prominent data has gotten, and I think we alluded to the fact of open banking as an initial inroad into this conversation, I think it becomes of paramount importance, because telcos, banks hold the masses of data. You lead that technology or that element of the financial services into open banking, everybody can tap into that data. Obviously, the biggest problem around that is data privacy, etc. But just circumnavigating that approach for now, the data is there. Talk about Branch, talk about Tala, talk about Paga, talk about any of the big players. They've got mammoth amount of data. Yeah, they've got mammoth amount of data from which they filter and start doing this credit score. I think the idea of a centralized system of rating, right? That's great to have. Like, for example, we do in the UK, or you guys do in the US. It's really helpful. But given in markets where that does not exist, I don't think continuing the rant that because it does not exist, lending and financial inclusion becomes difficult, I think no longer stands. Because everybody is now able to source data, scrape data from whether it is a digital smartphone or a dumb phone. Data scrapping is is very, very basic now. So I think we've passed the conversation, at least what I see, past the conversation of credit scoring, because as long as your algorithm supports that industry and it's being thought through, for example, Migo, right, which is now called, or previously called Minds, now called Migo. I mean, they've done something very clever where they've gone into the dumb phone space, and they've said, okay, fine, we don't want to play, with the branches and the talas of this world. Let's go to the base of the pyramid. And they're scrapping your SMSs, right? So they're checking what was the last bank account information that you received, or if you didn't, what about your energy bill? Did you pay that? Or did you buy anything for which you got an SMS? So I think credit scoring has become run of the mill, and this is where technology has played a really important part in Africa. That Africa has really leapfrogged from a centralized system of credit rating or individual rating to an individualistic rating platform. So I think that is the right direction. The disappointment, unfortunately, I have with fintech in Africa is there's certain segments of the market that have been tapped into, and certain echelons of the economy, the top segments, but the bottom just gets left out. For example, and this example may not be 100% apt, but one of the issues that we found in Nigeria during COVID was trying to get dollars out. The simplest problem anybody can solve, but nobody steps in, right? There's nobody that can say, oh, by the way, if you have a digital wallet, I will source the dollars for you, no issues. No.
But that's happening every day on the WhatsApp groups, right? It's informally happening. That's happening. I promise you. I've seen it. But it's not happening.
I need to talk to you because I need to get dollars out. But my genuine issue has been the formal channels have just not been performing, right? So where the formal channels fail, I know informal channels pick up. But I think that's a huge opportunity for the fintechs to really come in and say, this is why we want to disrupt the banking sector, because it just does not work. And think about the larger impact, and I don't want to take too much of the time, but the larger impact that Nigeria faces as a consequence is FDI investment stops, or at least slows down. Why get into that problem in the first instance, and why not fintechs kick in and solve the problem?
We can turn to Ruby because of the greenhouse role in Nigeria. And two points. One on credit scoring. I think I'm not quite as optimistic as Saad that it can all be dispersed and all these different entities can do it, because then what happens, and you've seen it in several countries across the region, is people just take so many different loans and no one has the meta to know that they have it all, right? Like it's except for maybe the telco, or maybe if they have a bank account, maybe. So there's still siloization of the data, and that I think can be a challenge. But would love to hear, Ruby, your reflections on the credit scoring piece and this Forex potential as a business for Nigeria.
Yeah, I think in terms of the credit scoring, I do agree with you, Aubrey. I think that there's so many different touch points, and a lot of them, just going back to kind of the point that you made earlier, a lot of these transactions are happening offline, right? Ultimately, when you look at majority of the transactions that are happening in Nigeria, most of it is happening in cash, right? And if you look at, if you take out the concentrations of Lagos and Abuja and these kind of hot cities or hubs, beyond that, majority of it's still cash, right? So how do you then collect data, transaction data for, let's say, that bottom of the pyramid kind of group, which is the vast majority of the country? And I think that's kind of, as you've mentioned, the challenge. Maybe some portions of it are going to be digitized and others are largely offline, cash in, cash out services via these agent networks that you've just talked about. And so I think part of it, a really interesting statistic from, let's say, places like Southeast Asia and Indonesia, for example, right? There's over 100% mobile phone penetration, and data is cheap, right? So you can see the use cases exist in other parts of the world. And yet they still have 50% unbanked individuals. They still don't have credit products that are targeted, as Ham said, targeted to the individuals. And so, when you see these statistics elsewhere, you kind of still, again, question that importance of the offline to online touch point that the agent provides. And I think the question really becomes, there is an opportunity to leapfrog, but how do we collect that data from that offline touch point and use that to digitize that data over the short to medium term and start actually moving towards a pure play digital kind of option, right? And then I think double clicking on this agent concept that you talked about, there's outside of regulation and outside of technology enablement, I think that fundamentally there is kind of relationships that you're building with that agent that the individual is building, right? There's an element of trust, right?
Experience. It's a social
massively, yeah. I mean, social, even when you look at savings, for example, right? If you look at traditional methods of savings, it happened in small groups, in known entities, in families and friends, right? If you look at the way you interact with, traditional ways of banking and financial services, even in Nigeria, people have 10 different bank accounts. And when you ask them why you've got 10 bank accounts, they say, actually, I just don't trust that my bank's going to be able to, operate when I need it to. And so I think there are a lot of these elements that are more cultural as well, that are ingrained into why, digital enablement hasn't necessarily kicked off as quickly as we'd expected. And then I think on the other side of this is there is an element of literacy and education, and how do you actually
agents can help with that too. Agents can be the vector.
100%. And it doesn't have to be, I really don't think it has to be specifically for, retail banking, right? I don't think it has to be for a particular type of financial service. I think it can be a distribution springboard for any financial service, for any type of product, actually.
But not even financial services. Like, look at Carry First, right? Carry
exactly.
First, is a gaming platform. And they had the #1 digital or downloaded game in Nigeria, which was a trivia game, right?
Mm-hmm.
But the way they distributed it was through individuals. You signed someone else up, and then they created agents actually out of people who were players. Whereas, like, if your friend had a mobile money account or whatever, you could just give them cash, then they transfer you credit in the game. So
it's a network effect, isn't it?
They became the agent in a way. And that can work for everything from gaming to financial services.
To healthcare, to it's anything, right? And I think you're right. It's about how do you tap into Africa's version of network effects. And I don't think it's the traditional definition of what we see as a network effect here in a developed economy, for example.
No, it just reminds you distribution is king, right?
Yes,
like distribution is king, the same way that Dangote had distribution for sugar at the beginning and other things. Distribution, once you got the sugar thing, you can put cement down that distribution channel. A lot of things can go down that distribution channel. Ham, did you want to jump in?
Yeah, I wanted to make a point on that. I think one of the interesting things that we sort of discover along this point, which is how do network effects work? How does agent banking fit into the equation? With financial services, you have this extra piece of you have to worry about things like money laundering, sanction screening, KYC, and Ruby, you mentioned 100% penetration and for mobile phones. Even the same thing applies in many countries in Africa. And the challenge that we found is that if you go and try to sign up people, many of those people don't have acceptable forms of ID, and so just at the KYC stage, you lose half those 100 million people. Or whatever population.
And some of those types of phones, people have 2 phones, right? They have 3 phones. And so the number doesn't actually reflect. And you talk to some people, and the number of senior people who are using pay-as-you-go, not actual contracts for data, is amazing still.
Yeah, that's still very much prevalent. And so you have these challenges where agent banking or agent networks work well in almost any other use case, but when it comes to financial services, you then have to worry about, all right, how is that money being collected? Who is it coming from? Who is the original source of that money? And where is it going? And those things become more complicated to control at scale. And those are some of the nuances that I think there is still quite a bit of work that has to happen in that arena. I know Smile ID, it does great work, Approve as well on the verification side, but there's still so much work that has to go into helping people actually get acceptable forms of ID, and then going beyond that and saying, all right, how do you then track source of funds if you use agent network?
And if you look,
I completely agree.
If you look at the India case, if you look at what's happened in India, that's really unleashed a second wave of the internet revolution, the data mobile revolution in India. It was basically two things: universal ID, which with an open API that went all across. I mean, they're registering millions every day, and the cost of data. Over 6 years, you saw the cost of data dramatically fall, and therefore YouTube, everything else go way up in terms of India. So those two keys are core to my view of inclusive of finance.
And then one last thing, which I just remembered, is there's this, every time someone, at least for Chip, or someone signs up, they have to do what's called a liveness test. So we actually they have to use their phone camera to make sure that that's a real human being who's alive at that moment. And coming back to the, not just cost of data, but the devices, a lot of low-end devices struggle at that point. So then you have a drop-off area. So I think when you think about the progression that's happening across those different facets, just the device is getting more powerful. That one, you have a webcam on your device, and then two, you can actually support a liveness test in the process of signing up someone. Those are things that we still have to navigate very carefully in our geographies that today people take for granted in the West.
And Ham, we had another question for you coming from the audience, which is, on cross-border payments, if you remember, BitPesa and what they've been doing, I think they changed their name now, but anyway, the point is they were using blockchain and crypto on the back end to manage those currency fluctuations. I mean, what are your thoughts about that approach?
So I think there's two main considerations there. One is the practicality of it, and then the second is the legality of it. I think a lot of central banks are still very sensitive to using blockchain or cryptocurrencies for remittance purposes. So that's one area that still has to be dealt with. And then on the practical aspect of it, there's an issue with volatility still applying to crypto assets as well. I mean, there's some stable coins now that could actually fix that issue, but there's still a consideration around if you use a back-end infrastructure that's based on blockchain or another asset that might have volatility, what happens when, over 1 million transactions, there's, 0.1% that changes every time someone sends it. And that adds up at scale, which doesn't really happen in fiat the way it does, because that's a more regulated and controlled by central banks. And those are things that we've looked at and tried to see how they could work at scale. And those are the two big buckets of issues that come up. But I think the biggest one, the technology will be fixed, as most technology problems tend to be over time. The regulation, I think is still the biggest piece, because central banks still want to have very strong control about inflows and outflows of money. And cryptocurrencies circumvent that in a way that they don't really like. So
Saad, maybe you can get your money out of Nigeria in crypto. You don't seem too thrilled on that idea.
Only that, but I don't know if that would work. But I will say one thing, I think there's a lot of focus on getting smartphone technology, smartphone penetration, and also cheaper data. Cheaper data if you get into smartphones, but I also think there is an appetite within Africa, at least for the base of the pyramid, to not go full tech, at least on the product, and still be able to use the financial inclusion space. I think that will, with that on the one kind of silo, and the second silo being cheaper data and cheaper smartphones, which is coming through asset leasing models, I think Africa has a great potential. But I think in the interim, I think there are non-fancy solutions available.
Yeah. Well, I want to switch to the conversation around who is investing. One of the things I've thought was challenging in this early stage of the venture ecosystems in African markets is the lack of corporate venture from some of the banks. Why isn't it that, if banks are struggling to reach more consumers, Ham, in your space of moving money across border, why aren't they investing in what you're doing, or why aren't they able to launch an app that does this? Ecobanks in, dozens of countries, and manages cross-border payments for their corporate clients, what's stopping the banks from A, doing the business themselves, or B, investing in entrepreneurs like you?
Yeah, I think on the doing the business part, the technology is a big part. It's not, I think we take for granted today how many great products are out there, but a lot of banks, that's not their core competence, to build great apps or to build great consumer products. So to build, all these banks typically have apps of their own that don't really work very well. And that kind of gives you a sense of how hard that is.
But that's why they could invest in companies that make them,
right,
like the rest of the world.
That's the second part, which is, it's a no-brainer that they should be getting exposure to, the Paystacks and Flutterwaves and other companies being fintech in Africa. But I think one thing all banks have in common across the world is that they're typically very slow-moving organizations. So if you think about, the time it takes for a deal to be sourced, diligence, and then closed, a bank would probably want to do that in like 6 months, given how many, people have to sign off in institutions such as the banks. And most entrepreneurs, that's too slow for them. Those cycles aren't fast enough. And I know that to be, we've been approached by a few banks in the region that want to invest in Chipper. And, after the first phone call, it gets clear that at best, it's going to be a 6-month process before, it comes out to a successful outcome in terms of getting an investment.
Although, Aubrey, maybe to jump in there and provide a contrarian view to that. I think, Ham, I completely agree with you. It's slow, sales cycles are so slow, it's really difficult. But there's a lot of banks that for which this is changing. So the likes actually of EcoBank with their startup challenges, Fidelity Bank, Standard Bank, who partners with the like of Founders Factory Africa, and are trying to really have these mechanisms to source companies that they can potentially then partner with or acquire, and developing internal VC arms and trying at least to sort of have a seat at the table and like play in the space. I think we're seeing that really changing like across Africa. And before it used to be just international players, and now we also see local players trying. And in our portfolio, we've had a few companies already striking deals and white labeling their solutions. For example, for a Standard Bank in South Africa, like an insurance company called Mobilife, actually has been a pretty big success story for us. And so, yeah, I think, it's slowly moving, but there's some positive energy like in that. And some companies are actually making intentional moves, like acquiring, for example, having in their boards startup founders. For example, the founder of Africa's Talking that joined EcoBank, Stanbic. And so, those I think are positive signs that we're gonna go towards competition or cooperation and partnerships more so than for the disruption mindset. And at Catalyst Fund, actually, we work very closely with both corporates and startups to make sure that those proof of concepts and partnerships are successful through what we call a circle of corporates. And the interest, even from second tier and third tier banks, like microfinance banks, who are still doing things like pen and paper and are not digital at all, have now this urge of like figuring it out. How do I digitize everything? And that's where positioning the Chipper like as a trusted partner. I think you could see probably opportunities arising.
Or the other way. I know digital players, startups who are going to acquire microfinance banks because they have a banking license, and the end goal is a digital bank, right?
Yeah.
Like the end goal of a lot of the fintech players is a digital bank. And the finding those regulatory ways around it. I agree it's early stages for corporate venture, but if you look at India today, like over 40% of all venture deals have corporate venture in it. So there's a long way to go, especially ex-South Africa. The South African players with Startup Bootcamp and others had long-time partnerships with Barclays. And I know that there's an Egypt, the CIB, the largest commercial bank in Egypt, has a venture arm now, doing venture investments globally. But also in Africa. So, early days. I think that what I see at least is that the Stripe buzz, the acquisition, is making a lot of people in Nigeria in particular, like, how can I invest in startups? And so, maybe there'll be some inflated valuations, but at least more people to the table. Ruby, I don't know if you're seeing the same thing.
Yeah, I was actually going to agree with Maëlys. I think that there's a lot of activity happening. But I think banks and these large sort of telcos have a little bit of a challenge internally, right? It's not really about, hey, we're interacting with startups and look at us, we're doing all of this work. I think the challenge is, how do you actually take these startups and now actually integrate successfully, right? I think they're moving at different paces. I think that, and we talked about this a little while back, I think, Mylis, but there's sort of this honeymoon period between kind of the relationship, right? You have the startup, they meet this corporate partner. It sounds great, they've got this massive vision, and actually over time they have some early wins. But beyond that scaling, that full integration, sometimes there are some challenges that occur around navigating the larger firm. Yeah. And so I think that there's two kind of aspects to this that I see. One is banks need to think like technology companies. So when you look at kind of the Goldmans and the JPs of the world, majority of their talent, like hiring now, 80% of those job ads are actually tech ads, right? They're for tech job fulfillment. And so I think the banks and telcos need to start thinking as if they were operating like a technology company and actually hiring talent internally to manage this type of integration. And people who understand kind of the way startups work, how nimble, how fast they are, right? And then I think on the other side, you need to almost have a separate entity that's dedicated to something like this, right? You can't just plot something in and hope for the best, right? And so you need to carve out, the banks need to physically carve out a team that understands how to operate with startups. They incubate those startups over a period of time until they're ready to navigate a large, more bureaucratic organization. And I think that kind of structuring, we haven't quite struck gold there at this stage. I think people are testing and iterating, but we're not in that perfect model yet.
Well, as we're getting close to time and this conversation has been robust and dynamic, we could keep going forever, but we can't. I wanted to kind of end on a question looking forward. We've been excited by the Stripe Paystack exit, but there's other exits too that have happened in fintech, a little less, in the lights, but they're happening. So, I want to go around and get all of your views on, what does it look like the next couple of years? How do you see exits? How do you see investment trends? And what are you optimistic about? This is often a trying period, 2020 and COVID. What are you really optimistic about, and what's kind of giving you inspiration during this time? So Mylis, we'll start with you.
Sure, I have the privilege of going first. So in terms of what we're going to see in terms of movement in the market, I actually think we're likely to see a lot more acquisitions of the Stripe Paystack because what this has done is having a demonstration effect, like proving that the opportunity is there. It's the entry ticket into Africa for some of those companies. And as you said, many others, Visa, MasterCard, like so many are actually already dating many of the fintech companies in the continent. And so the switch will happen. I think we'll see them in the next few years. And additionally, there's other kinds as well of big corporations that are looking at companies locally, for example, on the logistics side, like the Totals of the world or Toyota, right? So there as well, they're looking not just, for example, at other logistics companies, but at fintech and energy, for example, blended models. For example, one of our portfolio companies called Paygo Energy has Total as a key partner for distributing gas, like cylinders.
Shell Foundation, others are involved.
Shell Foundation, exactly. So that I'm really excited about because I think we're going to see a lot more. And yeah, the question, as you said, is probably what it's going to do for valuation and the price. So investors may or not be happy about that. I think generally happy, and more exits for opportunities. And then in terms of trends, we personally see fintech much less as a vertical today, but as an horizontal sort of platform, right? And so we're looking at embedded finance opportunities across the board. So we look at digital commerce, for example, where companies are looking at payments or even credit for the informal micro and small business and integrating that into their offering to improve retention, long-term value. We're looking at logistics as well. We're looking at healthcare and insurance. InsurTech is a big space. And other areas where basically fintech can be a force for good to enable better value propositions because you're meeting the needs of the customer.
Yeah, fintech is the infrastructure, and
Exactly.
the visibility of that exit is huge. I co-own a PR firm for the reason that you cannot invest in things you can't see. So visibility
Exactly.
is critical for opportunities. Now the world, I bet a bunch of people in the Valley are like, ooh, Nigerian fintech, that kind of thing. So Saad, I'll turn to you for a quick, look forward and what's giving you inspiration right now.
Listen, open banking is one of the key things that we're looking at right now. We acquired a bank in Uganda just, I think, 2 months ago, really looking to digitize that. And I think what we found out is all our businesses, there's digitization angles that we're creating within it, which are following, as Miley said, the horizontal of fintech. So within every business of ours, we're building that in. Although there is some tech out there, they don't necessarily work for us. So our healthcare platform, we've built a digital pharmacy and distribution model there. We're digitizing our bank. We're investing in open banking quite heavily. We're investing in digital or fintech enabled asset financing models. That is still very, very core to heart. So I think a lot of opportunities in the new year. We've not stopped, but we've not done remote due diligence either. So I've got a pile full of term sheets which are signed but waiting due diligence.
Ah, fantastic. Ruby?
Yeah, I think some of these sort of exit stories are fantastic, actually. I think that, as Miley said, it proves the thesis, and it also helps us move away from this blanket Africa discount that's imposed on a lot of companies, right? And then the other thing that I think is interesting as well is a lot of international investors are now starting to come in at earlier stages, where previously we saw homegrown angels, homegrown investors really supporting that early stage. You've got companies like Microtraction who kind of do that micro investment stage, companies like us who kind of come in right after. And so I think what we're starting to see is a lot more interest early on versus kind of in the series A, B, C stages, which I think is great as well, because obviously the two sets of investors bring different attributes to the equation, right? And then I think, of course, we're going to see, a lot of kind of the last 5 years, a lot of companies have kind of matured and grown. And I think we'll see a lot more kind of this merger acquisition play. But I also think that could even just happen on the continent and among players on the continent themselves, right?
Middle market exits are going to be key, right? You don't have to go big. We just need more and more exits and exit data.
Yeah. And I think when you've got two companies in two different regions or two markets, right, and they're doing effectively the same thing, sometimes it's easier to expand together, and consolidate through that means, and then you almost become more attractive to those international investors. And you also have the opportunity with that scale to even potentially have, small cap listings if you actually wanted to on AIM or wherever else, right? So I think those opportunities now expand with kind of the acquisition or merger play.
Yeah. Ham, you get the last word. You have 30 seconds. What's looking forward? Hopefully a big exit for Chipper.
I think it's for those of us who are in this space. The Paystack acquisition was massive because in many ways it shone a really bright light on what we've been saying and doing for the last couple of years, and now the whole world sees it. And I think that's always a good thing for our industry. And then also on a personal level, Shola is a good friend of mine, and I know just how much he's worked and how many sacrifices he's made. So to see those rewards happen and to see him get that reward, that has a profound impact on anyone who is in his circle and anyone who's close to him on a personal level.
Yeah.
I think representation is a very powerful thing. And to see a homegrown startup like that have a massive exit that is larger than many of the banks we speak about today, that's a powerful thing for all the other countless entrepreneurs in Africa that are setting off on their own journeys. So I think it was a massive win for everyone. I called him as soon as I saw the news, and I was super excited for him. And there's many more great companies coming up that, whether it's an acquisition or an IPO, I think we'll have lots of exits,
including your own. So with that, let me thank everyone for joining. It's been a great great conversation and one that will need to be continued. Thank you, everyone.
Thank you, Aubrey.
Thank you.
Thanks a lot.